Hi, my name is Michael Zhao. I'm part of the Grayscale research team, and today I'd like to chat about how crypto might fit into a diversified portfolio and why it's considered a high volatility alternative asset class. Let's start with the four things that really define crypto. First, it's volatile. Crypto markets can swing dramatically, more so than mainstream assets like large cap equities or investment grade bonds. And that's something to keep in mind if you're looking for stable price behavior. On the bright side though, that brings us to the second behavior, which is that the returns have been commensurate with volatility. Historically, Bitcoin and other digital assets have rewarded investors with higher returns to balance out that extra risk, which can put them in line with what you'd expect for higher volatility investment classes over time. Third, crypto has shown a relatively low correlation with stocks and bonds, meaning that its price movements haven't always lined up with traditional markets. That's a big deal from a portfolio construction standpoint because adding even a small slice of something that behaves differently can smooth out the overall ride and potentially improve risk-adjusted returns. Finally, there's the momentum factor. Crypto markets frequently exhibit price persistence, where gains can lead to more gains and losses can lead to deeper losses. It's somewhat similar to what you see in commodities or currency markets. This heightened momentum can create rapid run-ups during the bull markets, but it can also mean drawdowns can be steeper when prices start moving in the other direction. Monitoring positions or considering trend-following ideas may help some investors manage that volatility. Now, how could something so volatile help with a broader portfolio? That's where the idea of a little goes a long way comes in. Our analysis suggests that even a small allocation, maybe around 1 to 5%, has historically helped improve both total returns and risk-adjusted results in a 60-40 portfolio. It's partly thanks to crypto's high return potential and relatively low correlation to mainstream assets. Of course, there's no free lunch. Adding crypto does usually increase portfolio volatility, but from a diversification standpoint, that small piece of crypto can make an outsized difference when you look at the portfolio as a whole. How do you add crypto to an existing allocation? One common approach is to take a bit from other high potential or diversifying assets like commodities or small caps. Some investors also see private investment allocations as interchangeable with crypto, especially if they want the liquidity that public blockchain-based assets can offer. But no matter where you pull it from, it's critical to recognize that crypto is still a relatively young asset class, so its behaviors could evolve as the market gets bigger and more participants join in. At the end of the day, making the choice to include crypto depends on personal considerations like your financial goals, comfort with risk, and time horizon. If you have near-term capital needs or simply prefer more stable investments, you might need to keep your exposure very small, if any at all. But if you're on the hunt for new growth opportunities and a dash of extra diversification, then exploring a carefully sized allocation of crypto might just be right for you. For more on this topic, please visit grayscale.com/research. Thanks for listening.